Hey, Bulls and Bears, we are back again with another dose of economic reality. It is Thursday, March 23rd, 2023, and we are in the midst of the economic collapse. We've been collapsing economically, financially for years, but it's just now that people are starting to realize it with the big bank failures that we've just witnessed here. But leading up to this, we did see obvious signs that things were not sustainable. The levels of debt that was being taken on as a country, as individuals here, as people, it was just not sustainable. So, there was a lot of speculation about what was going to be the first thing to collapse. Was it going to be the consumer? Well, the consumer's been collapsing. The consumer's been propped up with rescue packages, forgiveness programs, um, a lot of money creation, a lot of debt, a lot of people living off their credit cards, living off of debt, low interest rates, giving people the availability to refinance at lower rates for homeowners, for example. Borrow, spend, pretend that everything's fine, but we knew it wasn't sustainable. We knew the banks were loaning out more money than they have. The banking system is insolvent. The banks are all insolvent. It's just now that people are realizing that these banks are so leveraged that they don't have anything, real assets or real money to cover what they're loaning out, to cover their liabilities, right? So this all is a house of cards, and it was just a matter of time. Everybody on this channel knew it. You all should know it unless you're just brand new to finance in general, or at least what we talk about on this channel. But let's talk about the next set of news here. The data I found today, it's a lot more of the same, and a lot, maybe a few surprises will be thrown in here as well. A big, huge layoff announcement. Seems like at least every other day or two, huge layoff numbers. If the economy was recovering, remember the narrative since 2020, since things technically reopened in mid 2021, late 2021, things started reopening, getting back to normal. With the lockdowns and everything else, with the health crisis, there was this narrative. There's an economic recovery. There's a recovery. That was the word that was thrown around to the phrase. The other phrase was we're strong. And we also heard that we have a strong economy, that the banking system was sound. We have these stress tests that show everything was fine. The banks are in excellent shape. The consumer's in good shape. And then we research here on this channel, and every day, we dig up things that show just the opposite, that the consumer's in maximum debt, most consumers anyway. We see that the banks are leveraged like we've never seen before. They had to pass all these new bills and things like that said the banks can loan out all this money that they don't have. Emergency measures were never gotten rid of in many cases. So we're going to dig into it, but first, a word from our sponsor. Noble Gold Investments have made it their mission to stay on top of the most important news. 3 bank runs in less than a week. These are the second largest and the third largest runs in history. The government is taking steps to guarantee all deposits. That means more money printing. Plus, the Fed is sitting on $1.2 trillion in losses on their $8.3 trillion bond portfolio. And the Fed will continue to raise interest rates even if they tank the economy. Do you know who are the only ones that are not afraid? The ones who are invested in gold with Noble Gold Investment. Gold is the most stable asset outside of any government control. Thousands have approached Noble Gold Investments to get their hands on gold. Hurry and go to bullboomgold.com to secure your wealth now and get a free 5-ounce America the Beautiful coin with each gold or silver IRA if you qualify. Go to bullboomgold.com, bullboomgold.com. You can also see the link in the description of this video and down in the comment. And speaking of investing in hard assets, like we just heard from our sponsor, gold today up to $19.97 as I read this. Silver up to $23.32. That's a over 2.5% gain about for each one of those. So hopefully we'll see some reality get into the precious metals prices, right? It's already, gold is already approaching the all-time high here, but economic reality is going to be entering these particular assets very, very soon, in my opinion. A lot of things are being done behind the scenes to keep the price tamped down on precious metals. We see that central banks have been accumulating precious metals for years, and we've seen record accumulation over the past few years of precious metals. And that comes at a time when we're looking at this alternate monetary system, this alternate money that's going to be coming out with the BRICS nations. Not just an alternate money, but an alternate system of trade at the same time. So it's going to get very, very interesting. We're going to see the dollar. They're going to attempt to have it digitized, completely digital. Will the new currency also be digital? And this CBDC, as many are calling it, or will it be something completely different, backed by precious metals, or will it be a combination of both? We're yet to see, but we do know that precious metals has a spot in the future of the system of money. First, we have to see the collapse of the current money. It's happening right now with the banks. It's happening with the consumer. It's going to be a balance of which one collapses the hardest and the fastest, right? We've got some other news to get into that's going to kind of paint the picture of where we're headed and what's going on here. One of the indicators that we said we need to look at, and we've been looking at, is bankruptcies. And we've got some big news out today. Distressed debt just soared by 29%, or about $66 billion in 1 week amid a surge of bankruptcies. I'll read you exactly the breakdown here that I've got here. There were 48 large bankruptcy filings this year so far through March 20th. That's the highest since, guess what? 2009, the financial crisis. How many items, how many figures and numbers are we seeing that are the worst since 2009 financial crisis, right? So just the numbers, the figures, the levels of debt tell us that we're in a financial crisis. It's just most people haven't realized it yet because the 6 o'clock news hasn't come out and said that. Of course, the 6 o'clock news is saying just the opposite. There's a recovery. The banks are sound. Well, at least up until recently, they said the banks are sound. But now they're saying the other banks are fine, that this is contained. There's not going to be any contagion. And that all the other banks are just fine. Well, we know the opposite is true. We know that the banks are technically all insolvent. If you look at what real money is versus what's happening, they're loaning out digits on a screen. And they're bundling these loans into bonds, treasuries, securities. Now, more into this here, a way that a lot of companies survive is they offload their debt, bundled up as treasuries, as securities, as bonds. And that's how they maintain operations with somebody buying the debt. But in this case, the Fed had been unwinding their balance sheet. Of course, they bump it up now with the liquidity injections into the banking system. We'll talk about that here in a little bit. But companies have been surviving off someone buying their debt, someone buying their loans, bundles of loans packaged up in securities. And what a lot of these companies were doing is they were pricing in low interest rates lasting forever. People thought we were in a new norm of rock bottom interest rates. They never thought that something would happen that would force the hand of the rate deciders to go ahead and raise interest rates. So now we're going to see a lot of trouble. And this surge in bankruptcies, the biggest one since 2009, it's just getting started. There's going to be a lot more bankruptcies headed to us very soon here down the road. Businessman investor Bill Ackman's out there saying, quote, "We're headed for another train wreck," unquote. He blames Janet Yellen for restarting the bank runs. Remember, Janet Yellen came out and said we could see the small and regional banks rescued and the depositors there covered for over $250,000. She said we could, but then she poured more gas on the fire when she said we're not going to see any broad increase of the FDIC limit. It's staying at $250,000. In other words, anyone rescued with deposits over $250,000 that could be rescued is going to be a special case. Again, back to what she said when she was questioned there. She said if it's a risk of contagion, if the bank failure is a big enough risk to cause contagion or overall financial instability, then they may decide or could decide to go ahead and rescue those depositors. So that didn't put a lot of confidence, of course, into the large depositors, people with more than 250,000, and therefore the bank runs continue. We reported what just after the bank collapsed, maybe a few days after that, it was about $500 billion, $550 billion that was withdrawn out of banks from people scared and pulling their money out, and a lot of them putting their money into the too big to fail banks. Well, now that number is up to $1.1 trillion that have been withdrawn. So bank runs are continuing. And of course, Miss Yellen didn't add much confidence to most people. Unless people weren't listening very closely, you would not have gotten a very confident message out of what she said in that question and answer session. But the depositors, both individuals and businesses that have more than $250,000 in the banks, they have a lot of skin in the game. So I think I'd have to say most of them were listening very closely to the words that were said. You know, when you have that much skin in the game, you're going to be listening to what the powers that be are saying. And Miss Yellen again poured fuel on the fire there for the bank runs. Bank runs are continuing. What's that going to mean here? Well, very soon I think we're going to see more news of more banks failing. Can they inject enough liquidity into these banks to keep them operational? It's possible, but then we're going to be looking at the inflation fire continuing to burn hotter and faster, because the more banks are out there propped up, loaning out money that they shouldn't be loaning out, the more consumers can borrow and spend, and that's just going to create more inflation. If something happens where there's a systemic failure of the banks, that's when you're going to see deflation. And many people are thinking that the powers that be cannot keep all of these small banks lending and operational. We already see banks are starting to cut lines of credit, especially regional and smaller banks. I've gotten reports here of credit card lines being slashed, people getting denied more now for loans. We see that for automobile loans, denials are at a 6-year high. We just talked about that a few reports ago. So things are starting to emerge here that are letting us know that credit's going to be tightening, and it is tightening as we speak here, but it could get much, much worse. And we know that without credit, debt, and spending, this economy comes to a screeching halt, and it's going to become obvious that we're in an economic collapse here to everybody that's even paying half attention to what's going on. Now, let's jump over to France real quick here. Headline here, USA Today. Heaps of trash pile up on Paris streets amid protests against France's retirement law. They bumped the retirement age from 62 to 64, just like that, snap of a finger. No vote, just, okay, we're going to make you work 2 extra years. And the ones that are outraged the most are the blue-collar workers, the ones that actually have to do physical labor. And that's why we're seeing heaps of trash piling up on the streets. These are the trash collectors, the workers that actually go out there and do the work. These are the people that are, you get 62 and your back starts to hurt, you're working a physical job all day. That's pretty upsetting to see, okay, now it's 2 more years before I can retire. White collar workers, I mean, I'm sure a lot of them are upset too. When you're sitting in an office all day, it's a bit different though than when you're actually going out doing physical manual labor. So the trash collectors obviously are revolting here, and I've got a lot of pictures here of just trash piling up on the streets of Paris. All right, the layoff announcement that I mentioned at the beginning of the video, this is a big one. Indeed.com. If you've ever looked for a job, you're probably familiar with Indeed.com. So 2,000 layoffs from Indeed.com. So what does that tell you? A company that finds people jobs, laying off 2,200 people. That should tell you that something is not going well with the economy. I thought there was an abundance of jobs. That's what we were told. Most of the jobs that I saw, most of the places I saw that were hiring were fast food places. And I think people didn't want to work fast food for the most part, because even though they had bumped up their pay in the last few years, the pay didn't reward people enough compared to the cost of living. So people were looking for better jobs. So I think it was the big open spot for jobs. Open jobs was the fast food sector, the service sector economy. But we've proven that time and time again here on this channel anyways. So Indeed.com, 2,200 people. So those people, 2,200 people, are going to be looking for a job themselves. And will they go to Indeed.com to look for a job? Or will they go to a different job website? Pretty interesting. All right, another story here that kind of caught my eye here was BuzzFeed. BuzzFeed, financial companies are encouraging Gen Z credit card holders to pay rent with their credit cards. It was typically that landlords and property owners didn't want to accept credit cards as payment because the charge later can be disputed. So of course they wanted a check instead of a credit card transaction. So credit card companies have now found a way to use the credit card, but to send it to the landlord as a check, so landlords would accept it. So this is another sign of distress, in my opinion. I mean, credit card companies now encouraging people to use their credit card to pay rent, and this is out of BuzzFeed here. Though many Gen Z adults still prefer other forms of payment over credit cards, companies are launching new credit card programs that incentivize young people to use credit cards for their rent and other large expenses. So again, another sign of distress, or just credit cards looking to put people further into debt and get more interest, from these people. From this article here, his interest rate is 28.7%, which is much higher than average. But this individual named Lamar called it a no-brainer decision because he pays it off in full each month, so he never accrues interest. He says it's a significant risk to take. Housing is typically the person's largest expense. So if the balance rolls over month to month, the interest rolls up quickly and can snowball. So yeah, hopefully these people are not any of the ones getting laid off, because you put that on your credit card and you're going to be insolvent very, very quickly, especially if you lose a job, if you have an emergency expense that's more than you can handle. But yeah, very interesting with the credit card companies having people do that. That's another sign of distress to me. As I am recording this, all major indexes in the green, with the biggest one up right now is the NASDAQ, up 1.8% as I'm recording this. We still have a few hours until market close today. So the markets are confident, traders are confident, but depositors are not confident. They're pulling the money out of the bank, over $1 trillion now. So something's got to give, and we're going to see more economic reality rearing its ugly head here very soon. So please come back to this channel if you like what we talk about here. Please give me a thumbs up if you like this episode here, and we'll see you hopefully down in comments. Keep stacking, everybody. Bye for now, and peace.